Close. USA Today's Adam Shell tells us what to expect following the increase in interest rates on March 21. USA Today: with interest rates on the rise, and expected to climb even higher, plain old cash is looking more alluring to savers and conservative investors. A savings account stashed with cash was the place to be for people who wanted to sleep at night during the 2008 financial crisis. Its value held steady while the stock market crashed, losing more than half its value, and home prices collapsed. But it quickly fell out of favor when the Federal Reserve cut interest rates to zero to make borrowing cheaper and revive the U.S. economy. While pushing rates to historic lows gave stocks, real estate and other risky assets a steroid-like performance boost, it amounted to a death sentence for cash and certificates of deposit. The reason? It caused the interest payouts on cash to virtually disappear, hurting savers, conservative investors and retirees who relied on income from their savings. More money. Starbucks executive chairman Howard Schultz quits More Money. McDonald's opens new HQ in Chicago, hoping to stay relevant. More money. Can religious business owners discriminate after Supreme Court Baker ruling? But cash returns are inching higher again and becoming more attractive as the Fed moves to return rates to historically normal levels. At its next meeting on June 13, the Fed is likely to hike rates for the second time this year and boost its key borrowing rate to 2%, up from 0% back in late 2008. And Wall Street sees more hikes this year and next, pushing up the central bank's key rate to an even more attractive 3%. That's not to say savers will make a killing if they invest in cash or CDs. However, interest rates are heading in the right direction for savers, but you have to know where to look to get the highest yields, says Greg McBride, chief financial analyst at Bankrate.com, a site that tracks the highest yielding deals offered by banks and other financial institutions. You also have to do some research, McBride adds. More money. Trump tweet on jobs report may have breached a 1985 federal directive. More money. How low can it go? Sears will close 63 more stores. Is yours on the list? More. SUV and pickup fever, U.S. Auto sales beating expectations so far in 2018. You are leaving money on the table if you are not shopping around for the best rates, he says. Heads up to yield seekers. Big, well-known banks are stingy when it comes to boosting interest on savings and money market accounts. After years of seeing profits dinged by low rates, the big banks, which are flush with deposits, are demanding higher interest payments from borrowers but not extending higher rates to savers. If you are sitting back waiting for your bank to bestow higher yields on you, says McBride, you are likely to be disappointed. The average national yield on savings accounts, for example, is still a measly 0.09% and 0.18% for money markets, according to Bankrate.com. Despite that, the Fed's key short-term rate is now pegged between 1.5% to 1.75% and is likely to rise again next week. So where are the deals? Look for banks that are competing for deposits, such as online banks or digital financial companies. That's where you'll land the highest and most competitive rates. Right now, for example, Virtual Bank, an online bank and division of Louisiana-based commercial bank Iberia Bank, offers the biggest yield on money market accounts, 2.01%. That means a saver with $100,000 will earn annual interest of $2,010 versus $180 in interest at the average yield of 0.18%. That additional interest of $1,830 is real money that can offset the cost of groceries, gas for the car or unexpected home repairs. Virtual Bank's 2% plus yield dwarfs that of Citigroup, which pays 0.04% on money market accounts, and Wells Fargo, 0.03%, and PNC, 0.03%, Bankrate.com data show. The highest-yielding savings account on Bankrate.com is currently 1.9%, and while a nearly 2% return on cash pales in comparison to the Dow Jones Industrial Average's 25% gain last year or the tech stock pack Nasdaq Composite's 10% gain so far this year, it still marks the highest yield since September 2009, according to Bankrate.com. And, more important, the 2% yield on cash is now on par with the Fed's favorite measure of consumer inflation, which stood pat at 2% in April versus a year ago. That means holding cash won't result in a saver losing purchasing power. Certificates of deposit. Similarly, the highest-yielding one-year CD tracked by Bankrate now yields 2.35%, which is the best return in 9 years. But with rates likely to move higher, the best strategy to profit from CDs, says McBride, is to buy ones with shorter maturities, such as 1-year or 2-year offerings. That's because longer-dated CDs don't offer yields that are much higher. The top-yielding 2-year CDs, for example, now yield 2.75%, which is almost as much as a 3-year CD at 3% and a 5-year one at 3.10%. It makes little financial sense to lock yourself into a long-term CD when you can get a comparable yield on a shorter-term one that will mature sooner. You want to give yourself the ability to reinvest as rates rise, says McBride. Checking accounts. About half of checking accounts don't pay a penny of interest, and those that do pay very little. So if you just sold your house or a winning stock and are using your checking account as a parking place for your profit, you're missing out on interest dollars you can get from higher-yielding savings accounts or CDs. U.S. government bonds. Lending the U.S. government your money is always a safe bet because the American government has never defaulted on its debt. It's an even better bet now with a 10-year Treasury note yields around 3%, which marks a 4-year high. It also delivers a return that is a full percentage point above inflation. And the investment is less risky than stocks. Even if the 10-year note falls in value, and its yield rises, an investor that holds the bond to maturity will get all of his or her money back barring a U.S. government default. Safe income is back, Richard Turnhill, global chief investment strategist at BlackRock, noted in a report a few weeks back when the 10-year breached 3%. Investors no longer need to take on as much risk to generate enough return to preserve purchasing power, but not everyone thinks cash yields are high enough to serve as alternate investments to, say, stocks, which have potential for much greater returns. While cash returns have been growing, they're still not at the point where it makes sense to use cash as an investment strategy, says James Reagan, Director of Wealth Management Research at the A. Davidson, a money management firm in Seattle. Reader share the story, https://usat.ly/2jgxfkl